Welcome back. It's time for Forum Daily's weekly market update with Catherine Murray, host of the Buck Stops here. Take it away, Catherine.
Thanks, Dima. Hello, everyone, and welcome to your weekly market recap. I am Catherine Murray. Well, we are seeing somewhat jittery markets this week, U.S. markets as well as the TSX trending lower, really on the back of a couple of key items. Of course, we've got a big backup in that U.S. 10-year yield hitting around that 5% mark. That's the highest yield on the 10-year we've seen since 2007. And this all, of course, on the back of increasing Middle East tensions. So again, market's feeling a little bit jittery. We do look to see the S&P down by about 1% on the week. And interestingly, on the back of the Canadian weakness yesterday, the TSX is now actually in negative territory on a year-to-date performance basis. Stepping back in terms of what we're seeing in those U.S. markets today, we are seeing weakness in big banks as well as technology shares. We are, however, seeing the price of WTI help some of the energy stocks and the energy sector on both sides of the border, up by about 1.1% today. Markets, as I say, are very uncomfortable with this big backup in yields and the geopolitical tensions. And that is leading investors to recalibrate the valuations of risk assets. If in fact we've got higher for longer, what does that mean in terms of what the actual PE multiples should be on stocks, which we actually pay for forward earnings? So that's what's getting recalibrated in the market right now, and certainly has been. But again, maybe this higher for longer is something to consider. We did hear from Fed Chair Jerome Powell yesterday, and of course, always different and mixed takeaways from what he's saying. I would say maybe it leaned a little bit on the dovish side, but he certainly did say that the rate hikes in the future are not off the table. So a bit for the bulls and a bit for the bears. Speaking of which, the bullish case in the market is still that we will have a soft landing and that the U.S. economy is actually still quite strong. We saw that in the retail sales numbers. The bear case, of course, though, is the higher for longer interest rates and, of course, geopolitical tensions. And also, of course, you are seeing a big sell-off in some of the bonds with those rising yields. So what does that mean? And what is it indicating and who is selling? So that's something to keep in mind as well. We are in the midst of earnings season in the U.S. markets. Just two stocks to highlight: American Express, AXP. They did have a beat, but their fee revenue is down, which is somewhat interesting. And then CSX, the railway, they had a revenue slight beat on the revenue side, EPS slight miss. So something to watch as we gauge the economy and the economic strength. You can tend to see that in some of the rails. Away from that, as you look at the TSX, as I mentioned, we are now in negative territory on a year-to-date basis. We have seen, however, gains in material stocks as well as energy stocks. Speaking of which, it's interesting. Morgan Stanley has a note out that says that the Canadian oil and gas names are an interesting place to position yourself as we go through this energy transition, given the high dividend yields, as well as the free cash flow tends to be much stronger than some of its U.S. counterparts. So interesting research note there. I'd also point out, just from some headline perspectives on the business front, Desjardins is going to apparently lay off 400 people due to a slower economy. There's also a CTV poll out there saying that inflation and housing are two of the most important items to Canadians. I don't think that's a surprise to anybody. And on the economic data front here in Canada, two items to note. Retail sales did come in with a negative 0.1% month over month for August. And 6 out of 9 categories were down. That's important in terms of telling you the weakness in those retail sales. We did, however, see we saw autos lead the declines. Gas, however, obviously the price is higher. That was actually showing some strength as it relates to the retail sales numbers. Also, a big number this week in Canada was the CPI. Inflation did come in a little bit lower than people were expecting, 3.8%. That's a year-over-year number. That is leading investors to believe that perhaps the BOC, the Bank of Canada, next week on October the 25th, maybe it's only a 20% chance that they will raise rates. In other words, they'll hold steady at this 5% level. We will see. So and I would just also point out that on that lower inflation number, but also the diverging economies with Canada and the United States, US being stronger, you're seeing that Canadian dollar have a low, 11-day low versus that US dollar. So again, all of this is playing out in our currency as markets do. They play out in currencies as well as commodities. So two items to watch next week. In the United States, third quarter GDP will be released on Thursday. And then, of course, the Bank of Canada next week will be October the 25th. So a couple big items, Nima, to watch for as we watch these markets really just have a bit of a tug of war, a pull and a push. There's no doubt about that. I'll leave it there. Have a great weekend. Also, just point out, Rafi Talmaiz, Energy Manager's been on my show, so take a look at that. See you soon.
And that was Catherine Murray, host of the Buck Stops Here.